Hey there, welcome. Today we are digging into something that sounds kind of dry, asset valuation, but it's actually fascinating. It's all about how companies can legally tell very different stories about their own worth, all while playing by the same rules.
So let's kick things off with a puzzle. How is it possible for a company's net worth to shoot up by millions of dollars when it hasn't sold a single thing or earned any profit? Well, the answer is tucked away inside its financial statements, and it all comes down to how it values the stuff it owns.
To really get this, we've got to go back to square one. Let's imagine our company just bought a brand new delivery van. The very first thing we have to do is figure out its official starting price, what accountants call its cost for our records.
Now, in the world of accounting, this van has a specific name. It's a tangible, non-current asset. Sounds super technical, I know, but all it really means is that it's a physical thing you can touch, like our van, or a building, or a big piece of machinery, that the business is going to use for more than a year. These are basically the long-term workhorses of the company.
Okay, so here's where it gets interesting. The cost of the van isn't just what was on the price tag. It actually includes every penny spent to get that van ready to start working. So you'd include delivery fees, or even the cost of initial testing. But, and this is important, you don't include general business costs, like training your staff to drive it, or any administrative paperwork. Those things are just day-to-day expenses.
All right, so our van is officially on the books with its starting price. But right here, the company has to make a huge decision. It's a strategic choice that's going to affect its financial story for years. It has to choose how it's going to value this van over time. The company's basically standing at a fork in the road. Path number one is the cost model. It's simple, it's stable. You just take the original price and slowly decrease its value over time to account for wear and tear. Path number two, though, that's the revaluation model. And this is where things get really dynamic. With this one, the company periodically checks the market and updates the van's value to whatever it's worth right now. So, for fun, let's go down that more interesting path.
So let's see how this actually plays out. Imagine a couple of years go by. The van's been doing its job, but something weird happens in the market. There's a shortage of this exact model, and suddenly, used ones are in super high demand. Its market price has actually gone up. Time for a revaluation.
So after being on the road for a bit, and after we've accounted for that normal wear and tear, depreciation, the value of the van on our books has dropped to $60,000. But then we call in an appraiser to check the market. And get this, they tell us that our used van is now worth $90,000. And boom, just like that, we have a $30,000 increase in value. On paper, the company's total assets just grew by 30 grand, which makes the whole business look stronger. But wait a second, where does that $30,000 actually go? It's not profit, right? We haven't sold anything, so it's not cash in the bank. It's what's called an unrealized gain. So you can't just stick it in with your regular sales revenue. It goes into a very special account called the revaluation surplus. You'll find it in the equity part of the balance sheet. Just think of it like a separate holding area, a special bucket for value changes that didn't come from the company's normal everyday business. But here's the thing, revaluing the van isn't just a one-and-done boost to the balance sheet. That decision creates ripples, and it changes how we have to account for that van for the entire rest of its time with us. And the main rule is actually pretty straightforward. Since the van is now officially worth more on our books, the amount of value it loses each year from use, that's depreciation, well, that amount also has to be higher to reflect its new, fancier value. So what does that actually look like? Well, if the company used to record, say, $10,000 of depreciation on the van each year, now that it's based on the new $90,000 value, that annual depreciation expense might jump up to $15,000. And that higher expense actually reduces the company's reported profit each year. All right, all good things must come to an end. After years of hard work, it's finally time to sell our trusty van and get a new one. This is the last stop on its revaluation journey. When we finally sell it, figuring out if we made a profit or a loss is super simple. We just compare its final value on our books with the cold hard cash we get for it. So let's say its final book value was $80,000, but we only managed to sell it for $75,000. In that case, we have to record a $5,000 loss on the sale. And now for the final bit of bookkeeping, the final cleanup. Remember that special revaluation surplus account where we parked that $30,000 paper gain? Well, now that the van is gone and its story is over, that money gets moved out of the surplus account and into what's called retained earnings, which is basically the company's long-term savings account. That temporary gain is now locked in for good. So, what's the big takeaway from all this? It's that accounting for an asset isn't just about recording numbers. It's a strategic choice. By choosing the revaluation model, our company told a much more dynamic story, a story about an asset that held its value really, really well, making the whole business look stronger and more valuable in the process.
And that leaves us with one final big question to chew on. This whole process is perfectly legal and follows all the standard accounting rules. But does using it give you a more accurate picture of a company's health, or just a more optimistic one? It's definitely something to think about the next time you're looking at a company's financial report.